Hi everyone, welcome to the session. In this session, I'm going to discuss about a question relating to annuity. In fact, this question was raised by one of my subscribers. He is following chartered accountancy course in Sri Lanka. He is a business level student. So let's go through his request. Please answer this question. I confuse. Mr. Silva is 40 years old today and is beginning to plan for his retirement. He wants to set aside an equal amount at the end of each of the next 20 years so that he can retire at age 60. He expects to live to an age of 80 and wants to be able to withdraw 50,000 rupees per year from the account on his 61st through 80th birthdays. The account is expected to earn 10% per year from the entire period of time. So determine the size of annual deposit that he must make. So if you analyze the question, so what you can understand here is from 40th age onwards is planning to set aside a fixed amount of money every year for 20 years. Then at the age of 60, he wants to retire. Then he wants to spend 50,000 every year till his 80th birthday. So this question has two parts. First one is from the age 40 to 60, he wants to save an equal amount. But we don't know how much to save. Then from age 60 to 80, he wants to spend 50,000 per annum for 20 years. So in this case, we know the amount to be spent. So we know the spending amount from 60 to 80, so which is going to be 50,000. So it is better to start with the known figure. So we know that 50,000 is going to be spent from 60 to 80 years for 20 years. So it's a known figure. So it's better to start with the known figure. So if you spend 50,000 every year for 20 years, so he is going to spend in total how much? So 50,000 times 20 will be 1 million. So he is going to spend 1 million over 20 years. Then when he wants to spend 50,000 over every year for 20 years, so at the age of 60, how much he should have saved to spend that 50,000? So this is what we need to identify. Okay, to spend over this period from 61st to 80th birthday. Okay, so how much he should have saved by this date at the age of 60? So what we can do is we can identify the present value at 60, present value of the cash flows from 60 to 80. So he's going to spend 50,000 each year. So we can calculate the present value of these cash flows at the age of 60. So as you all know, the calculation of present value is easy. The present value of future cash flows, how do you calculate? PV is equal to the future value times 1 over 1 plus R to the power N. But in this case, you need to identify the present value of the cumulative cash flow. So we are going to spend in total 1 million. So what is the present value of that cumulative 1 million at 60? So this is what we are going to identify. So there is a formula slightly different from the present value formula. So you need to use that formula. What is the formula? Present value is equal to C stand for the cash flow times, you have to open a bracket, 1 minus 1 over 1 plus r to the power n, then divided by r. So this is the formula that we need to apply to identify the cumulative present value of the future cash flows. Now we know we are given 50,000. So the C is known, 50,000. So that is the cash flow. And also we know R is 10%. Also we know N is going to be 20 years. So simply take all this information and apply to the formula. Just substitute the formula to calculate the present value of the future cash flow. So C present value is equal C times 1 minus 1 over 1 plus R means 10%. So simply we can say 1.1 to the power 20, N is 20, divided by R means 0.10, so which is 10%. So when you further simplify this, present value is equal to 50,000 times 1 minus 1 over, then take 1.1 to the power 20. So if you apply through the scientific calculation, you can calculate the the discounting factor, which is 6.727 over 0.1. So if you further simplify this, present value is equal to 50,000 times, this will be, if you simplify the entire amount, it will be 8.51345. So present value of the future cash flow will be 50,000 times 8.51345, that will be 425,678. So he should have 425,678 at the age of 60, and so that he can spend 50,000 each year. At the same time, he will receive 10% interest on the balance. So he will receive 10% interest on the balance. At the same time, from the remaining the fund, he can spend 50,000 till his 80th birthday. So we have identified the amount to be saved, the amount that he should have at the age of 60. Now, what is the next thing? The next thing is we need to identify to have 425,000 at the age of 60. Now his current age is 40 years. From 40 to 60, this 20 years period, how much he should save every year to reach this goal? This amount, 425,678 amount, to reach at this point, how much he should save? So this is the second point that we need to identify. Now at the age of 40, to reach 425,678, so this is his future goal. So we need to identify the future value of the annuity. Okay, so if you deposit certain amount every year, so that you can arrive at this 425,678,000. So this is also an annuity. An equal amount is going to deposit. Okay, so since we are going to calculate, now you know how to calculate the future value. So future value is equal to present value times 1 plus r to the power n. Okay, so if you are given an interest rate 10%, and if you know how much is going to be invested now today, so you can, after 1 year's time, how much to be received, that amount can be calculated by using the future value. However, since we are going to calculate the cumulative future cash flow, so we need to apply another formula. So what is that formula? Future value is equal to cash flows times, C means the cash flow, times open bracket 1 plus r to the power n minus 1 divided by r. So this is going to be the formula to calculate the future cash flow, the future value of an ordinary annuity. Now the future value we know, which is going to be 425,678. We should reach this target. So how much to be saved every year? Cash flow, this is what we are going to identify. So then R is 10%, N is 20 years. So simply substitute these amounts to this formula. So what is the formula? Future value is equal to C times 1 plus r to the power n minus 1 divided by r. So future value is 425,678 times, so equals cash flow times 1 plus r means 1.1 to the power 20 minus 1 divided by r means 10%, so we can say 0.1. Then 425,678 is equal to cash flow times 1.1 to the power 20. If you calculate by using your scientific calculator, that will be 6.727 minus 1 divided by 0.1. So if you simplify this further, 425,678 is equal to the cash flow. If you simplify this amount, that will be 57.275 times C. Then C is equal to 425,678 divided by 57.275 is equal to how much? 7,432. So in order to reach his goal at the age of 60, his goal was to reach 425,678. He should invest now, from now onwards, every year 7,432. That will earn 10% interest. So over 20 years, he can reach the target amount to be saved at the age of 60, so that he can retire. At the time of retirement, he will have that fund. Then from his 61st birthday onwards till 80th birthday, he can spend 50,000 every year, and the fund will receive 10% interest on the remaining balance. Is that clear? So this is the answer for this particular question. So if you like the video, please subscribe the channel, and if you have any doubts or any questions, what you can do is you just leave a comment. I will try to solve all those doubts and your questions. So I'll see you soon with another session, another video. So until then, bye for now.